Hey guys, welcome to the Passive Investing Made Simple Masterclass. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at PassiveInvesting.com. And I'm so excited that you're here today. We do this masterclass live every Tuesday to help you learn the ins and outs of passive investing in real estate. Passively investing in real estate. Guys, it has been a Monday for me. I know I said it was Tuesday, but it has been a Monday for me. But anyways, if you are wanting to learn more about, the educational resources that we offer here at PassiveInvesting.com, or if you want to learn more about our open deals, you can visit PassiveInvestingWithWhitney.com. Now, today I have a very special guest with us, Scott Maurer with Advanta IRA. You guys have repeatedly asked questions on who I have my self-directed IRAs with, and I'm like, I gotta bring Scott on. We'll just get all of your questions answered directly from Scott. Scott, welcome to the show.
Hey, great, Whitney. Thanks for having me on. I appreciate you coming back on with you today. Hopefully get a lot of those questions answered for the people that have sent them into you.
Well, excellent. Well, Scott, before we get started, will you please take a minute and just let people know who you are, what you do at Advanta IRA, and maybe just a little bit of background on how you got into this space.
Sure, no problem. Yeah, Scott Maurer with Advanta IRA. I'm currently our vice president of sales here at the company. I've been with Advanta almost 20 years, doing self-directed education. I've helped process different kinds of investments, and so over my time here, I've seen quite a different array of different investments, but a lot of it that we see is real estate based, which is why I love coming on and talking with you, because I know that's obviously what you're passionate about too. Real estate and real estate related assets, I should say. My background, educationally, I'm an attorney by degree. I don't do any legal work for Advanta clients. I'm not permitted to kind of cross that line. For our Advanta clients, I do some legal work outside of Advanta. But that's my background. I got started with the company. Our owner, Jack Callahan, also is an attorney. That's how we connected. And I started with the company, like I said, almost 20 years ago. I knew very little about IRAs, much less self-directed IRAs at the time. And just spent a lot of my time learning my first, few months or whatever, learning from Jack and learning from talking to people. And definitely over the years have just grown that knowledge. And really a lot of it has been through our clients and people who've brought us unique and different types of investments that they wanted to hold inside of their IRA account. That's what we specialize in at Advanta IRA, is holding things that you can invest in, but things that a lot of brokerage firms and traditional custodians just simply aren't willing to hold. And so that's what we do at Advanta IRA with a self-directed account. Like I said, that's a little bit on my background. Our offices are based here in the Tampa Bay area, but we work with clients all over the country.
Well, thank you so much for everything that you do, Scott. If you guys are not following Scott on Advanta IRA, he does have regular educational sessions as well, and then does some connection events with his investors. I mean, they're not investing in Advanta, but the accounts that you custodian for them. Well,
Yes.
Scott, I have 15 questions, and I'm sure our listeners will chime into the Q&A box and add in more, so I'll be happy to facilitate the Q&A box as well. But I've got 15 questions lined up for you, and maybe we make it
Okay.
through all 15. Maybe we take a left-hand turn somewhere in here. Who knows? But the point of today's webinar, what I want all the listeners to get out of the end, is that they fully understand when the self-directed IRA is, what they can and cannot invest in, maybe a little bit of primer on how they can open up one. But maybe we get into some of the tax stuff around UDFI and
Sure.
everything like that,
Absolutely.
the hot topics. All right. So let's kick it off. Can you just give us a high level overview of how a self-directed IRA works and how it differs from a traditional IRA?
Really, yeah, thanks, Winnie. And I kind of alluded to a little bit a few minutes ago regarding what we do, but a self-directed IRA, it's important to note that the self-directed is really the moniker we use to describe the ability of the IRA client to invest in assets that they understand, that they can control, or maybe that they're more comfortable investing in than maybe what most people associate with IRAs and 401ks, which is mutual funds, stocks, assets like that. The IRS rules allow you to invest in anything that's not considered life insurance, or a collectible. Those are the prohibited asset classes. So you're allowed to invest in a wide variety of different investments, including, practically speaking, most kind of conventional IRAs limit you to publicly traded assets. If you think about a Fidelity account or a Merrill Lynch account, that's your restriction, is really what's available on their platform. But the IRS rules allow you to invest in really anything, again, that's not collectibles and life insurance. So people investing into single family rental properties, people lending money from their IRA to third parties, people buying gold and silver as part of their portfolio. That's what we specialize. That's what a self-directed IRA is. We at Advanced IRA, we don't sell any of those investments. We're not going to promote or tell you you should or shouldn't do any investments. It's up to you, really, with a self-directed account. And it's you're finding the investment, you're telling us what you want to hold. And our job is to manage the process, manage your funds, moving from your current custodian over to Advanta, and then Advanta making that investment on behalf of your IRA, keeping that all tax protected, because IRAs and Roth IRAs are great, great tax vehicles. You want to make sure you're preserving that tax status, and that's what we do when we help you just take that IRA cash and invest it in something different.
Well, and thank you for going into that. It does spur many questions, in my head that I want to ask you. But, something that I tackle with our investors quite often is, even say like you have just a hypothetical 500,000 in a, Vanguard account, already sitting in a traditional IRA, you can, and correct me if I'm wrong, Scott, just open up a self-directed IRA account and just move what you want to invest into, say, like the PIC real estate debt fund, or like, one of our equity offerings, and leave the rest of it intact. So you can actually have IRA monies at two different institutions. Is that correct?
You absolutely can. That's one of the great benefits of IRAs in particular, is that you can have, like you said, multiple IRAs. You can have an IRA with Advanta, an IRA at Vanguard, an IRA at Schwab, and you can freely transfer money between those accounts whenever you'd like, as often as you'd like, as long as the money is going strictly from one custodian to the other. So in your example, yeah, if you have a $500,000 IRA with a brokerage firm, but you only want to say, the opportunity you're presented or that you would like to pursue is a $100,000 investment in the debt fund, you simply transfer over the $100,000, you make that investment, you leave the rest of your cash at the brokerage firm. And if 6 months later you come across another opportunity, you can move another 50 grand or 100 grand or whatever that amount is over to an account with us, or vice versa. Investments pay off, you can send the money back to your brokerage account. So it's definitely not an all or nothing strategy. It's something you're getting true diversity within the assets held in your retirement plan. You can hold the publicly traded assets with the brokerage firm, and you can hold the alternatives in the account with us.
And I love that. And I love pointing that out to investors, because when that finally somebody explained that to me, I was like, light bulb went off. That was huge. Now I want to touch on the prohibited assets just really quickly. Why
Sure.
can't somebody invest in life insurance or collectibles? I mean, I understand you don't want to invest in vintage wines because I might drink them. I don't know.
Right.
It's probably unsafe to have those around the house, but
Right.
anyways,
Yeah.
why can't you do that?
So I think part of it might be public policy. They don't want you investing and reaping rewards and tax-free gains off other people dying in life insurance. I mean, that might be part of it. I think some life insurance is already tax advantaged. That one I'm not as sure on, but the collectibles, like the vintage wines, like the rare coins and stamps and automobiles and things like that, I think the issue with those is that the IRS does rely on an annual valuation of your account to determine your required distributions each year and how much you're supposed to take out of your account. So valuing your IRA is very important to the IRS. And I think, your idea of a painting and its worth is going to be different from mine and different from the other people on the call. So it's more of an arbitrary figure. And so I think that's why collectibles, that's one reason why collectibles can be prohibited, is really the fact that they're difficult to value. The other, as you just alluded to, if you have a vintage wine, or again, you have a vintage painting in your IRA, but it's hanging in your house, you are also getting a benefit of being able to look at the painting and get the tax benefits at the same time. The IRS doesn't want you getting any current benefit from the assets held inside the IRA as well. So I think that's a couple of the reasons why. That there's certainly never been anything from the IRS that said this is why no life insurance or this is why no collectibles, but and that's kind of what we've gleaned over the years.
Mm. Well, let's kind of switch back. If somebody is intrigued by this, what are kind of the first steps? Like, how should they look for, what should they look for when choosing an SDIRA custodian?
I think for choosing a custodian, you want people who are responsive, who will return your calls, who you have, dedicated customer service, which is what we do. I mean, I think that's the most important thing I've found over the years really has been the customer service level I know that I give and that my colleagues give as well. We're dealing with people's retirement accounts or with their IRAs. This is money that they have saved, they've put away over the years, they've made contributions to. This is their nest egg. And it's very important to them, regardless if it's a $50,000 IRA, a $500,000 IRA, or just somebody getting started, it's their money. So you want somebody who's going to give you that level of service and attention to your particular account. And we do that. We do that at Advanta with the account managers that we attach to every single account. Also, I mean, look for one that provides education. We do a couple of educational events a week on different topics. We like to speak at events like this when invited by Whitney and other people. So it's really trying to find not only a company that will educate, but that where their staff is also educated. That when you're talking to the people about a new account or about what you're looking at investing in, that they understand it as well. Because if they don't understand it, it's not that they won't be able to process it, but just going to take that much longer, maybe that many more steps of having to explain it.
Mm. All right. And so this is self-directed IRA. What, when somebody moves their account over, are there some surprises like around in processes around bookkeeping, submitting forms to the government that now that they take on, or like how does that work? What kind of support do they get in making
Great
sure that they
question.
stay compliant?
Yeah, great question. So as the IRA custodian, we take care of all of the IRS reporting for our IRA accounts. So for the traditional IRAs, the Roth IRAs, the SEP IRAs, if you make a contribution to the account, we are going to report that to the IRS. If you take a distribution from the account, you're actually pulling money out, we report that to the IRS on a 1099. We ask again for the annual value of your account, and we report that to the IRS on a Form 5498. So we take care of all the tax reporting for the IRA. The only things that you would have to we're going to report it to the IRS, but the things that you would need to do as an individual is if you make a contribution, you have to report that on your 1040. And similarly, if you take a distribution, you have to report that on your own 1040 so that your numbers on your 1040 jive with the numbers that we're giving the IRS on the forms that we file. So it's a good question because I get asked that a lot. Hey, if I'm buying real estate or I'm investing in this private fund in my IRA, what other things do I need to do with the IRS? What do I need to tell my accountant? If you're not taking a contribution or you're not taking a distribution from the account, and most times, there's nothing you would need to even tell your accountant about because everything is happening inside of the IRA. It's a tax neutral event to you. So there's nothing for your CPA, your tax advisor to report on your tax return. Again, the only thing we will ask for every year is for you to update us as to the value of the assets held in your account. We send you a form. You can get with the people you're investing with, get us back that value, and then we just report that number to the IRS.
Well, and I know you're not an accountant here, but can you clue us in a little bit on the bookkeeping piece? Because as my accountant, let me know if I invest through the IRA, whether it's traditional, Roth, Solar 401k, it doesn't matter. All my income and expenses run through that IRA, and I now own as the investor all the bookkeeping for that. Would you say that's true?
Yes and no, because it depends ultimately on how you structure the investment. So I kind of refer to it in two different methods. One is kind of the custodial method of purchasing an investment. Another is the checkbook route that some individuals go down where they get more control. So taking the custodial method, if an individual comes to us and says, I'd like to buy a piece of real estate with my IRA account, or I want to invest in a fund, we're going to make sure all the paperwork gets titled properly when the investment is made. Make sure the client approves of it. But then going forward, the income is going to flow back to the IRA. So we will receive and deposit that rent check, for example, or that monthly payment back into your IRA. If there's any expense related to the asset, you would direct us to pay it. So you would be involved in telling us, hey, I need you to pay the property tax bill or the maintenance bill or the insurance bill or whatnot. But we actually pay that out of the cash in your IRA under the custodial method. So we are keeping all of the records of the money in, the money out of your account, clearly listed right out on an annual account statement. So that's the kind of the custodial method. You buy the asset just directly in the name of the IRA. There is another investment strategy that people utilize called a checkbook IRA or a checkbook LLC, where the client establishes a separate or brand new LLC, a limited liability company, that is owned by their IRA account, and that becomes the asset of the account. And in that checkbook LLC, instead of having Advanta receive rents, pay bills, and whatnot out of the IRA directly, the IRA owner directs us to send all of their cash in the account to the LLC's bank account. And then from there, the IRA owner will have their own bank account for that LLC and making their investments and handling their investments through that entity. So with the checkbook method, if you went that route, you are going to be responsible for more of the bookkeeping of the income and expenses, tracking that. Some of the reporting would still be done by us with on the IRS side, but kind of two different ways to do it. There's really not a right or wrong way to do it. It depends on an individual's kind of preference. And if you want more control over the funds and you want to be able to act quickly at an auction, sometimes that checkbook IRA or checkbook LLC is the way to go.
Hmm. Well, now that we talked about some of the mechanics of SDIRA account, I want to get into the assets and kind of how they function within the account. And I
Sure.
know you made it very clear you guys don't do any of the due diligence on the asset. You just make sure from a compliance standpoint that it is something that can be invested in. So
Correct.
everybody, if you use the self-directed IRA, you have to learn how to do your due diligence. Make sure you're tuning into our Passive Investing Made Simple boot camps where we teach you those skills. But can you give us some real life examples of how investors have successfully used SDRA accounts to invest in syndications and debt funds?
Yeah, no, I mean it's one individual that I met years ago. Yeah, he moved a large chunk of his IRA to us, and just over the years have invested in different syndications. And so every time a new syndication or new opportunity came to him, he would review it. As you mentioned, he has to look over the prospectus, do the due diligence, and be comfortable with the investment itself. That's not something we're going to do at Advanta. But when he decided, yes, I would like to pursue this investment, he provided us with the subscription documents. So when you invest in a private fund, there is the ownership paperwork is reflected in subscription documents where you list the name of the investor, you list the tax ID number, the address, et cetera, for the investor itself. And again, our job is to make sure that the investor is listed as the IRA account. So it'd be Advanta IRA for benefit of Joe Smith's IRA is the subscriber, and that's what goes on the paperwork. So for this particular client, he did this numerous times with a lot of different syndications and private funds. Every time we would fill out a subscription document, we'd send it to him for his review and approval. The investment got made, and then every month or every quarter, he would get back what he would call mailbox money. The money just goes to the mailbox. Of course, with his IRA, it came to us and to our mailbox, and we deposited it. But he was successful just passively investing in real estate. Just new syndications came up, he would put more money into it. As the syndication would pay off, he'd get the cash in his account, evaluate some other opportunities, and just rinse and repeat over and over again.
Well, and I know this is going to trigger a question, which we'll get to here in a second, a tax-related question. But before we do that, what are some common misconceptions that, people, about using an SDIRA account? And I think I'm going to ask this at the same time. How can somebody screw this up?
Yeah.
Right? Like, how can somebody blow this apart?
Yeah. So blowing it apart would be doing something that's prohibited within the account, is how you can mess it up from that standpoint. So I mentioned you can't buy life insurance and you cannot buy collectibles. The other restriction that the IRS has is your IRA cannot engage in a transaction with somebody who is considered to be a disqualified person. And so if you're on listening to the call, if it's your IRA account, your IRA is its own separate legal entity. But the disqualified persons for your IRA include yourself, your spouse, your parents and grandparents, your kids and grandkids, any business or entity that those individuals control. So you have to be careful when your IRA is making investments that no disqualified person is transacting with them. So you can't lend money, for example, to yourself or to your son or daughter. They cannot lend money to your IRA. If your IRA owns real estate, you can't be working on the property. Your IRA should be hiring and paying third parties to actually do that work on that particular investment property. So that's some of the pitfalls, I guess, of how people can kind of blow it up. I think one of the common misconceptions, though, that people have is, oh, this is too advanced for me. Like, all right, a self-directed IRA. That's yeah. I started thinking about it. Just that sounds like something that I'm not smart enough to do, or I'm not savvy enough to do. And it's not about that. It's about someone finding an investment, something they believe in, something they understand more, and deciding to make that investment. It doesn't matter what you have, degrees, no degrees, what degrees you have. If you have funds in an IRA, you can do it. And that's something we try to help people with, is understanding what their options are and understanding what some of the rules are. So I think that's the trepidation in getting started, is I haven't heard about this before. So it must be something that's kind of, above my pay grade, for lack of a better term. And it's not. We have people, it's very simple to do. Once you get down and you start to understand it, or you have us talk to you about it, it really is a very simple process, a very simple investment to make.
Well, amazing. Okay, I want to kick this up a notch because, a lot of people that are listening to the call are, have invested in multiple syndications before. And the question that we get quite often from syndicated investors or people that are investing in real estate is, how does unrelated business income tax work? Like, can you walk us through how UBIT, unrelated business income tax, works, and UDFI, unrelated debt financed income, works, and how they apply to SDRA investments? And maybe
Yes.
start us off at the definitions and then move us up to the
Yeah.
301 level.
Yeah, we'll definitely do that, because it's a little bit of a complicated subject. Before I delve right into that, a lot of investments with IRAs, if they're just cash investments, there's no underlying debt, anything like that. The gains from an IRA to an IRA just go back into your account, tax deferred or tax free if you have a Roth IRA account. So in a lot of situations, this doesn't necessarily come up. But UBIT, or just by unrelated business income tax, and its sister or brother, UDFI, unrelated debt financed income tax, are two very rare taxes that it can apply to any nonprofit or tax exempt entity. And since your IRA is a tax exempt entity for purposes of investing, for the most part, those taxes can apply. What UBIT tax is, specifically unrelated business income tax, is if an IRA in this case is receiving business profits back to the IRA account, the IRA can be subject to that tax. Business profits could be your IRA invested into a restaurant, and every month you get a cut of the profits from the business. That's opposed to you investing in a stock and your IRA is paid back passive dividends. That's not business income. So UBIT, business income, is if your IRA is actually receiving profits in a business itself, active profits. Again, its sister, UDFI, unrelated debt financed income tax, can apply to an IRA if your IRA is investing, say, in real estate or some investment where there is underlying debt in that investment. So if you invest into a syndication, and that syndication is, say, 70% leverage, they raised 30% of the capital, they borrowed the rest of it, 70%, your IRA can be subject to that UDFI tax because your IRA is now investing in a leveraged real estate asset. So that's kind of the definitions of UBIT and UDFI. Now, how they apply is, we'll use UDFI because we're talking, the syndication model. Again, we'll use an example where the equity in the property is 30%, the leverage is 70%. If you have an IRA invested in that deal, your IRA would be subject to UDFI tax on the percentage of income relative to the debt. So if the property is 70% leverage, that means 70% of the income going back to the IRA is going to be subject to UDFI. So using some numbers, If you got $1,000 dividend check back from your syndication investment at 70% leveraged, $700 of that would be subject to that UDFI tax. So it's kind of a tax that a lot of people aren't really familiar with, and it's a tax, importantly, and to note, it applies to your IRA. It does not apply to you personally. It does not show up on your 1040. It is a tax that applies to your IRA. Your IRA can take deductions. Your IRA can take depreciation to limit how much UDFI would even apply to the account. So usually for the first year, maybe the first 2 years of a syndication, if there's enough write-offs, your IRA won't owe a dime of UDFI tax. But once that starts to go away, it's a tax that can apply to your IRA account. And that's something where you would want to have a tax advisor assist you in those calculations. But it's somewhat of a complicated subject, but that at its base is what it is again, it applies to the percentage of income relative to the percentage of debt in the asset. So as that investment gets paid down, so let's say initially the project is 70% leverage, but after 3 or 4 years, it's down to 65 or 60%, then the percentage of income subject to UDFI is going to decrease.
Well, thank you for that explanation. And again, it really is, a complicated subject. And sometimes I've sat down with my accountant and, she's helped me pencil out the UDFI impact on investments in my IRA. And, I hear, oh, a 60% tax. No, there's fractions here. And so,
Yes.
the tax impact was pretty minimal. And like you said, I was getting depreciation. I was getting all these other benefits back to the IRA to help lessen that impact. But really, the tax strategist is going to be the one, your CPA, they're going to be the ones that are able to answer that question for you.
And I think what you made a great point there that people understand too. It's 60% or 70% is what is subject to tax. That does not mean you are paying that amount in tax. That is the amount that is subject to. That'd be like saying, if I work at my job and I have $100,000 a year salary and I'm subject to tax on that 100,000, I'm not paying 100,000 in tax. We all understand that from that standpoint. So it is a smaller percentage, and you do get the write-offs and depreciation from that. And the important thing to note for UDFI specifically is that it applies to IRAs. It does not apply to 401k plans. So if you are somebody who is self-employed or has a side business, you can qualify for something called a solo 401k plan, something we offer at Advanta as well. But it's a 401k plan just for you and your business. If you don't have any employees, you qualify for that type of plan. And 401k plans do not pay UDFI tax. So that is a way that if you are self-employed, a way to just skirt right on past that UDFI issue.
And how would somebody know if they could qualify for a solo 401k?
I think talking with an accountant is a good idea. I mean, I can assist to some extent. First off, if you have employees in your business who are W-2 employees, you're not going to qualify. But if you're self-employed, you don't have any employees, again, it can be a side business as well. You could have, you work a 9 to 5 Monday through Friday, but on the weekends you do something different to earn a little bit of income on an independent contractor basis, for example, or sole proprietor. You would qualify to have a solo 401k plan. It's having that separate business that is just you and that you are deriving income from.
Well, thank you. All right. What are some high-level strategies investors can use to structure their SDIRA held investments and maximize returns while staying compliant with the IRS?
Well, that's a loaded question. That's a big one. I mean, I would say that, we talked about the checkbook LLC strategy. I think that's a mechanism that helps people maximize what they can do because you have one entity. Your IRA funds are invested into that LLC. You're acting as the manager. Now, you don't pay yourself. That can blow up your IRA. But if you're just using it as a passive investment deal, you could invest in notes and real estate and tax liens and tax deeds, and you can invest in a brokerage account through that LLC, keeping all of your money working at the same time. I think has proven to be a pretty good strategy. I think looking for assets that can give you both some cash flow and some appreciation can also certainly be helpful. I think depending on what investments you're comfortable doing, but that's always been, to me, I think, to be most successful as an investor is to know your limitations or know what you really want to do and don't kind of stray too far from that. I mean, if you somebody who is more active and you want to go buy your own rental properties and you want to manage your tenants and whatnot, use some of your talents there. That might make more sense to you than sitting back passively, right? And just getting that mailbox money that my client told me about. But again, knowing your limitations. If you're someone who's more passive and dealing with tenants doesn't sound like a great idea to you, then don't get talked into buying a rental property where you're going to have to manage your tenants because you're going to eat up your time. You're going to get frustrated, and that's going to hurt your overall return. You're just not going to be as attentive to it. So I would say know what you're looking to invest in and kind of stick to it and keep your money working. Importantly as well, you don't want cash just sitting around, doing nothing. Put it in something that will earn a yield.
Mm. Well, Scott, we have some questions, the more personal investing focus or,
Okay, sure.
personal related to personal situations. So we'll save those for the Ask Me Anything part of our show coming right up. But I wanted to kind of wrap up with one question here. What advice do you have for investors who are just getting started with self-directed IRA? And what are the first steps and, that they can take and pitfalls they can avoid?
Yeah, I mean, the great first step is getting educated. Don't I wouldn't say don't educate yourself to the extent that you never do anything, right? Because we've all kind of seen those people who, I just need to know more. I just need to know more before I get started. I mean, at some point you do need to get started and get going, or you'll be 10 years down the line and still where you were 10 years ago. But get educated. There's, the self-directed IRA, it can get a little complicated. We just talked about the UBIT and UDFI tax. That sounds too involved, then find something that doesn't trigger UDFI. And that's something you can call myself. You can call a member of our team. You can watch one of our many webinars and join that, where you can find about different investments that don't have some of those issues involved, and keep it simpler. I think getting started. I think that's probably one of the biggest pitfalls are people that I've seen over the years. They want to do a self-directed IRA because somebody told them to do it, and somebody's kind of pushing them along to do something that they're really not comfortable with or they don't really fully understand, but they just go along with it because somebody else is saying to do it. And at the end of the day, they're not happy. Maybe they lost some money in the investment they were making. So I think getting educated and not trying to do too much too soon.
I love
I
that.
mean,
And
yeah.
I talk to my investors all the time. Sometimes we'll identify ways for them to optimize their investment with their retirement funds. And they're like, oh, UDFI, I don't want to do real estate. And I'm like, that funds are amazing and they can
Hmm.
still help you grow. And then you can also use the compounding features of this debt fund and keep it all tax deferred in an
Yep.
IRA account or tax-free in a Roth account. So there's some very powerful methods to combine, these strategies together.
Yeah, and I think as we talked about earlier, it's also when you're getting started, it's not like, oh, I have these $200,000 in my IRA. I guess I got to find something to do with all of it. No, you found your first investment. Hey, this one sounds good. It's only $50,000. Let's get started with that. I'll leave the rest of it alone until I'm ready and I get more experience or I feel more comfortable about doing it. Is you have that flexibility with IRAs to move portions of them back and forth. So I think that's a very important thing to note. Again, something I've seen with people over the years where I'm not ready for the whole amount. Well, that's great because you don't need to. You can just use what you're comfortable with.
Mm. Well, Scott, thank you so much for spending your time, knowledge, and expertise with us here today. Guys, don't go anywhere. We're about to start the Ask Me Anything part of our show. But before we do that, Scott, how can people reach out to you if they're interested in learning more?
Sure, they can reach me. Our website is advantaira.com, just for good general information. If you want to reach me directly, it's my first initial and last name, SMAURER at advantaira.com. Shoot me an email, set up a call, or just give me a call directly at 800-425-0653. My direct extension is 1123. So just give me a call. Again, I always say it's webinars and forums like this are great places to get some really good information to get started. But every one of you on this call is going to have your own unique search circumstance, your own unique questions that do need that personal connection, that personal touch. So give me a call. We're happy to get that answered for you.
Awesome. Scott, thank you so much for your time with us here today. And
Oh,
if
you're
you're
very welcome.
live, yeah, if you're here live, thank you for spending your time not only with us, but investing in yourself. Don't go anywhere. We're about to start the Ask Me Anything part of our show.